Welcome to SIRA MCQ YouTube channel. Today we discuss advanced level A-level accounting paper question number 45. Look here, this is related to accounting ratios. We must know the accounting ratio and the meaning of the accounting ratio. Look here, what is this requirement? Complete the following statement using the appropriate accounting ratios. We must include the accounting ratios. Look here, first one, high blank ratio indicate that firm is heavily relying on debt capital. Relying means depend means this is the basement. Okay, relying depend on debt capital. Look here, high blank ratio indicate, there's a ratio indicate showing that what is this, there is a ratio showing what is that firm is heavily relying, heavily depend on debt capital. Debt is depending on debt capital means debt capital is high. Okay, depending on debt capital means debt capital is high. You know debt ratio. How can we calculate debt capital dividing in total capital? You know the total capital include debt capital and equity capital. The basement of total capital, the debt capital is higher. In that there is a percentage, no? Percentage. You know this is 80%, no? 80% means total capital is 100, but debt capital is 80%. Debt capital is top of this. Debt capital. Total capital is 100. The debt capital is 80. This is the debt capital is higher. Why? Therefore, we can think the debt capital is the depend person means the debt capital is higher. Therefore, the company should obtain more loans, more long-term loans to carry out their business. In that case, high ratio indicate that the heavy relying depending on debt capital is higher. This is showing debt ratio. Okay, look here, next one, high blank ratio indicate that firm collecting cash efficiently from trade debtors. High blank ratio indicate showing that collecting cash efficiently means collecting cash immediately. Okay, collecting cash efficiently means collecting cash immediately from its trade debtors. You know there is a there are two major ratios impact to trade debtors. What is this? First one is debtor turnover ratio. You know how can we calculate debtor turnover ratio? Credit sales dividing average debtors. This is the calculation method, no? What is the meaning of the debtor turnover ratio? Debtor turnover ratio meaning is the debtor how many times come to the business. Look here, what is the meaning? Debtor turnover ratio meaning debtor how many times debtor come to the business. You know this is ratio is 5%, no? 5, sorry, number of is 5. 5 means year, the current year there are 5 times come to the turnover ratio is 5 times means, look here, 5 times means debtor come to the business over the period 5 times. Okay, the debtor, this is debtor turnover ratio is 10%. 10 times he come to the business. Okay, this is the debtor turnover ratio, meaning in that time they said that 5 times he come to the business at that time. This question is said cash collection. Do you think about this? 5 times means 5 times only come to the business, therefore he ignore these cash payments. Look here, there's 5 times come to the business for the year, therefore his payments was paid not nearly. Why? 5 times, only 5 times. Look here, 12 months, no, divided by 5, 2 point. After 2 months or 3 months he come to the business, therefore their collection is weak. Why? This is the credit sale point, no, today. In that date, after the 3 months he come to the business to paid in cash. Okay, after 3 months he came to the business and paid cash. In that point, this is a weak cash. The 5 times means he do not come to the business, and do not come to the business means he do not payments. Okay, he do not carry out their payments to us. Therefore the 10 times means he come to the business again and again. Look here, this is 20, no, 20 times come to the business again and again. At the come to the business we can collect the cash. At that point the cash collection is efficiently, cash collection is immediately getting from this time. The debtor turnover ratio, he come to the business the time of the coming times, we can indicate there's a debtor turnover ratio is higher. The debtor turnover ratio is higher, we can collect 20 times from debtor. Okay, in that form debtor turnover ratio is higher, we can collect in cash efficiently 20 times, 40 times. Therefore debtor turnover ratio is debtor turnover ratio indicate that firm collecting cash efficiently. Why? Turnover ratio is higher, he come to the business again and again, we can again and again collect the cash from the trade debtors. Okay, next one is the major one. Look here, when the blank ratio of the company is significantly means there are large amount of portion lower. When this ratio of a firm is significantly lower, this is lower. Okay, this is lower than this is higher. Look here, when this ratio of a company is significantly lower, this is lower than this ratio, this is higher. Okay, it indicates that firm has to rally means depending on selling inventory to meet the short term liabilities. Look here, there's a selling inventory related ratio meet the short term liability. Short term liability means current liability related and inventory related. Okay, what is the ratios? Ratios are current ratio and current ratio and quick asset ratio. What is the current ratio calculation? How can we calculate current assets dividing current liabilities? How can we calculate the quick asset ratio? Quick assets dividing current liabilities. What is the meaning of this? There's a current asset, no? Current asset, this answer is 2 times, no? 2 times means I write this one there. 2 times. Okay, answer is 2 times. 2 times means 1 rupee current liabilities is there to 1 rupee current liability payments is in current situations. We have current assets to pay the 1 rupee liability 2 rupees. We have 2 rupees for payment for current liability 1 rupee. Okay, this is the current ratio. Current ratio means we have payment 1 rupee in current cases. To payment for 1 rupee we have current asset 2 rupees. Okay, there is a quick asset ratio. Look here, quick asset ratio is 0.5. How can we the meaning to payments for current liabilities is 1 rupee. We have daily payments, current liabilities 1 rupee. To payment for current liability 1 rupee, we have quick asset only 0.5. This is not enough for quick assets. What is the meaning of quick assets? Quick assets is the current assets, but current assets without closing stocks means inventory. Closing stocks and closing prepayments. Ignore about closing prepayments, closing inventory. Look here, the quick assets and current asset ratio, the difference is the quick assets include without closing stock. There is not include closing stocks. Current asset include closing inventory. Okay, closing stock. Okay, this is a quick asset not include closing inventory. The quick asset means without closing stocks. Okay, in that point, look here, there is a quick asset ratio. Assets have only cash amount, trade receivable amount, other receivables. There is no closing stocks. This is the cash amount, cash only cash 0.5. This time there is 2 is current asset. The difference is this 0.5 and 2 is this include all current assets. Therefore, we can think this is include cash 0.5. Why 0.5 is cash there? And what is the 1.5 is remaining? This is what is the remaining? Closing stock. Why? This include closing stock. This is not include closing stock. Therefore, this is 1.5 remaining. 2 of 0.5 is cash. Why? 0.5 is cash. And 1.5 is closing stocks. Closing stocks. Therefore, you can think, look here, there is a difference. We can imagine that we have to pay current liabilities 1 rupee. 1 rupee current liabilities there and there. This is the same amount. Okay. And that point there are cash amount is 0.5. This is not enough for payment for current liability. Therefore, to pay the 1 rupee current liability, we must use what is that? Inventory. Inventory must sell immediately our inventory. Why? The current cash amount is not enough 0.5 to payment for current liabilities. Therefore, we must use the closing stock for payment for current liabilities. Okay, this is the meaning of that. We can find the answers based on that. Look here, this is the when the lower ratio of the firm significantly lower than its ratio, it indicates that firm has really depending on selling inventory to meet these short-term liabilities. Therefore, we can imagine that the lower is quick asset ratio. Quick asset ratio. Quick asset ratio. Quick asset ratio. The higher is current asset ratio. Current asset ratio. Why is the lower than the current? Look here, quick asset ratio of the firm significantly lower. Why? 0.5 lower than current ratio. Therefore, we can think, look here, this is the current situation. The quick asset ratio is lower significantly 0.5, but current asset ratio is higher to. Okay, therefore we must use the inventory for paying current liabilities. Therefore, we can easily confirm that there is answers. The quick asset ratio of the firm significantly lower than the current asset ratio. It indicates that a firm has to really means depending on selling inventory to meet the short-term liabilities. Therefore, these are the answers. After that, we must meet question number 46 in next video.